Now let's do an example of an NPV question with the information that we just picked up. So this example says a company is considering a project that has a investment of 56,000, and it is going to generate after-tax cash flows, which is good because that's what we need, 15,000 a year for 5 years. And they also say it can be sold at the end of the life of the project for 4,500. And you're required to maintain inventory of $3,000, which will be fully recovered at the end. Okay, so that is going to be the working capital that is required. And the last bit of information they give is present value of the CCA tax shield is 67.55. So they made life easy for us. We don't have to calculate that using the formula. They've already given us a present value, and the discount rate is 10%. Okay, so the question, I would say, we would lay it out the same way as I did before. So let's write the description of each item, and we can fill it in as we go along. So there's the cost of the asset, and then there's the initial working capital, and then there's going to be the present value of the after-tax cash flows. Okay, so the cost, let me write the directions down as well. The cost of the asset and the initial working capital are going to be negative, the cash outflows. And then the money that we receive from the project will be a positive, as will the present value of the CCA benefits. So they will be a positive. And then the present value of the salvage, because we're going to sell the machine at the end, will be a positive. And then the last thing is, at the end, we're going to recover the working capital. Okay, so the inventory that we bought at the beginning. So recovery. And that will also be a positive as well. Okay, so let's start by filling in what we've already got. We know that the asset is going to cost $56,000. And we don't need to do any discounting on that. It's in today's dollars. We are also told that the inventory, the working capital, is going to cost $3,000. And the other given is that the present value of the CCA benefits is plus 67.55. Okay, so what we are going to be solving for is the after-tax cash flows, the salvage value, and the present value of the recovery. And this is going to be an annuity because it's going to be for 5 years, same amount every year. And these two are going to be the present value of lump sums. So let's do it one at a time. The annuity, actually let's do the easy stuff first. Let's do the present value of the salvage. So the present value of the salvage is equal to the $4,500 that we will get for salvage at the end of the life, divided by 1 plus the discount rate of 10%. And the project life is, how long did they say? 5 years. Okay, so let's put 5 here. So the present value of the salvage is going to be $2,794. Okay, so we can fill that one in here. Positive 2,794. And the working capital recovery is also simple to do. That is going to be the $3,000 that we get back at the end of the life, because we've sold off all the inventory, divided by 1.1 to the power of 5, just like salvage value. And that works out to 1863. Okay, So that is positive 1863. And the only thing left is this annuity, this after-tax cash flow. And this is going to be the present value of an ordinary annuity. And this is calculated as follows. So it's going to be the amount, which will be the after-tax cash flows, times 1 minus 1 over 1 plus r to the n, or k, whatever you want to use as a discount rate. And in this case, the amount is $15,000 times 1 minus 1 over 1.1 to the power of 5 divided by 0.1. So we get 56,861. And now we can put that is the last missing piece here, 56,861. And if I add up all of these together, I am going to get an NPV is equal to 9,273. So it's positive, so therefore we proceed.